Welcome back to the Money Under the Mattress podcast. My name is Jake and my co-host is Mitch. And today we are joined by Durable Investments. We met Durable through Twitter, where we came across his threads on qualities of good businesses. We're excited to talk to him today to learn more about who he is as an investor and what qualifies as a durable investment. So thank you for coming on today with us, Durable.
Absolutely. I'm glad we're doing this. I told you guys this before, but I'm so glad that you guys are doing this, providing platforms for people to come in and express their opinions. So keep doing this.
Awesome. Yeah, thanks for coming on with us today. And we've been in contact, as we said beforehand, with Greenwald as well as Cinchstock Poppy, who we had on before. And they were like, yeah, you got to get Durable Investments on to this guy knows a lot about AWS and PASS and IASS. So it's going to be an exciting one today. Usually the first question we always ask right off the bat is, how do you get started in investing?
Sure. I'm a software engineer by trade. I work for one of the big tech companies. Like many retail people, most people are told, go with indexing, S&P 500, that's your safe bet, save up as much as possible, invest in S&P 500, and you should be good for retirement, right? That's the advice that I got, and I did that for a while. But the concept of investing in private companies always eluded me for the most part, and I was like, there must be some science to it, and maybe I should dig deeper. And that's how I got into it. Basically, one fine evening, I asked my wife, who was then a financial analyst, asked, what is a financial statement? Tell me about it, right? And she basically went over what an income statement is, how the different lines differ from each other, things along those lines. And I was like, well, this is very exciting. I should learn more. And found Buffett, found Charlie, found a lot more people who explained how the business of public equities work and how you can capitalize on top of them. And here we are. I think for the most part, my learning process has been finding the answer to this one math. So I did this, right? So I was told that compounding is one of the greatest miracles, right? And I was like, wait, let me do a calculation. So I did this, right? So if you have saved up $100,000 and you're compounding at 15% for 30 years, this is the math that I did on one of the Kager calculators, it would result in $6.5 million, right? That blew me away, right? I was like, wait, now, like, I'm not adding anything to it. How is it possible? And basically everything that I've learned from that point onwards is to find how that 15% can be achieved, right? That's the core of it all, in my opinion. Found that, like, through various learnings, found out that your return, your internal rate of return, is going to be equal to the sum of the yield the investment produces and the growth to it, right? I was like, wait, I don't get it. And this is what I did. I basically opened a spreadsheet and extrapolated, like, I basically assumed it's a house, right? You're buying a house for, let's call it $250,000. And I assumed, okay, for a $250,000 house, let's say that the rent that you get per month is $2,500, right? And over 12 months, it would be somewhere around $30,000, right? And I used that as the yield, extrapolated for 100 years. Let's assume that the house stays for 100 years. And I added a growth of, let's call it inflation level growth, so 3% over 100 years. And the $250,000 that you invested right now, the internal rate of return for that, when you calculate over 100 years, would be 5%, which is the yield, and 3%, which is the growth. And I saw that math, like hard math, in an Excel sheet. I'm like, this is amazing, right? So it unlocked a lot of things for me. It basically said a business has to survive for that long amount of time. Number one, which is guaranteed by a lot of things. One of the main things is competitive advantage, right? And next question is, how would a business have competitive advantage? And I dug into how different businesses have different types of moats, right? Red Pat or C, Red Buffett, and on a lot of these things, and found out that over for different types of businesses, you have different types of moats, right? If you take social media companies and cigarettes, their moat is sticky customers, right? Habitual customers who come back to them again and again and again. And after all of these researchers found out that a moat is nothing but finding an answer to why do customers choose this company over other companies over long periods of time? What makes them come back again and again and again, right? That's the core of it. Once you start applying to different industries, you'll find those answers, right? So that is the duration part of it. And the second level of learning is growth. I was like, what is growth? Like, I did not understand the concept of growth, and I had to dig deeper as to how growth translates into compound interest instead of simple interest, right? Because yield is a simple interest part. Growth is when you take the rents from a home and you invest into another home, right? So this is the reinvestment part of it. So once I learned that concept, started identifying those patterns in different industries. So it's basically, like I said, that 15% of 100,000 resulting in $6.5 million. Unlocking that particular equation resulted in me learning over about moats, yield, the growth part, and various different things, right? Leverage. Leverage is something that people really underestimate. Leverage and compounding goes hand in hand, right? In the same equation, so let's say you have the capacity to borrow one more $100,000 and you invest it in the same way, let's call it the borrow cost of 3%. That $6.5 million at the end of the 30 years would be now $11 million, right? Which is, oh, okay, this is how leverage works, right? So it's all unlocking that particular equation. That's the core equation I'll go back to. And that's how I became from a total nerd who does coding day in, day out to so addicted to finance and FinTwit, and I can't get off of it.
Interesting. So do you think that you'll ever want to move away from software engineering or coding?
No, I think software engineering, as I've started reapplying what I've learned in finance over at software engineering, I've come to this core understanding that software as a business is one of the most moatiest businesses around for various different reasons, right? And personally, choosing career-wise, that means that I have, by chance and by luck and some passion, I have found a field that I actually like, that is actually a very lucrative business to be in, right? So when a business does well over time, that means that every single stakeholder that's part of the business are going to be doing well. So, and I actually like what I'm doing, so I don't think I'll stop doing software, stop being in software engineering, but at the same time, I think the intersection of both these fields is going to be very interesting. From my perspective, I think I can add value from being in both the fields and see where it goes.
That makes sense. What are, in your words, what are some of the key traits that make a durable investment?
A durable investment is basically the moat part of that equation, right? For any of this, growth plus yield is equal to your IRR equation to work, the business has to survive that set period. And that set period for this particular issue to work usually crosses 100 years. And in this day and age with ever-changing technology, business lasting 100 years is a very tough proposition. So if you are on the lookout for only durable businesses, your funnel becomes narrower and narrower, and you'll end up with very moaty businesses, right? If one of the there are multiple, you can answer this question with multiple factors. It's not a single 0 or 1 kind of question, because the multiple factors would be how sticky are the customers, right? So that's the most important part. Why are the customers choosing to do business with this business entity as opposed to the others? What is making them come back? For a business like AWS, it is because they can't just easily switch away to a different vendor. These are very interlocked. The business and the engine that runs it are very interlocked. It takes years amount of work to even get them out of there. For a business like tobacco, it is as simple as customers have preference for a single brand, and they don't like change, and they keep going back to it, right? And for an industry like defense, it is as simple as you are guaranteed that your core customer, which is Department of Defense, will keep on providing contracts. And this is essentially a bet on US's security, right? It's as eternal as it comes in this business, right? As you can pinpoint this in different industries. And at the end of the day, the only question that you have to answer regarding the durability is, would it outlive me, right? And if the answer is yes through all these questions, then it is probably a good investment to dive deeper, dive deeper into.
When talking about moats, what would you consider your favorite moat, or the one that you look for when looking for an investment? For example, like the low cost producer, switching moat, network effect, scale economy shared. What exactly is your favorite moat?
I think the switching cost is one of the most interesting moats to look at. So when you analyze switching cost, you will have to analyze the incentives of every single player involved. If you take a business like Oracle started out 50 years ago, and one of their core products is a database. If you think about database, it is where every single information about the business is stored, right? That's how they started. They basically created a huge database, and they said, you know what, any customers can use our database to store their information. And database is almost like the engine of a business, right? That's the core of it. And because of that, the switching cost is way too high, right? When you write code that reads data from a database and writes back into it, you're basically integrating with the database at the lowest level possible. And you're built out as a company who has utilized Oracle's database, You have built out software systems on top of software systems, and your whole business runs on top of it. And then, let's say 30, 40 years after you've done this, Oracle isn't doing that well. Their databases aren't that great. They are lacking features. You decide to move away to a different database. It is not easy. Companies spend 8 years, 10 years slowly stripping off these databases from their running software. That is the most important part of it all, right? You can't just move databases. It takes time because you have to keep your software running while you're moving databases. One of the analogies that one of my directors have used before is switching out the core underlying infrastructure. It's almost similar to changing the engine of an aeroplane while it's flying, right? It is one of the hardest things to do. And if you think about incentives, why would a company do that, right? They would do that if the product they're using right now is utter garbage, right? And if the existing products out there are much better, much better, for them to get the return on investment on that 8 years worth of work, right? And that usually doesn't happen. And if the company is doing right by their customers, that's what you have to look for in all of this. If a company is doing right by their customers, and they have this high switching cost, your company will outlive you. And your customers will, as long as they don't see the benefit of switching to another vendor, they will be with you forever. So that's one of the strongest moat that business can have, in my opinion. There are several others, like network effect is a very strong moat. Like we all know the Facebook and Google Plus story, right? Facebook built it out. People were hooked on it. One of the very first things people do is in the morning, open their phone, click on Facebook. It's a habitual thing. It is so hard. There was no incentive on the customer part to switch to a new social network because Facebook already has it, everything, right? And in this software industry, once you establish network effects, it is easy to copy any new additional features that your competitor might have within a matter of months. There is no IP protecting any of these. Like we all know about the stories feature that Snapchat had, like it got copied by Instagram just like that, right? And once you have the capacity to copy from your competitors and you already have 1.8 billion people using your app day in, day out for a couple of hours a day, just like watching TV, you've got yourself a moat. And there's no denying that. And it's going to be very hard for any upstarts to provide incentive for the customer to actually make that switch. And it happens for newer generations. That's the catch in all of this, right? In the case of Facebook, TikTok acquired a new generation because the new generation, they were not hooked on to the previous platform. So in this social media business, the new generation will be incentivized to use a different platform because of various things. Children don't want to be in the older platforms and things like that. But that doesn't mean this business is bad, because you have Facebook as an entity has basically locked in 2 generations worth of people in their ecosystem, and these are the earning group in this day and age, right? Millennials to the generation after. So they're going to be spending for the next 25, 30 years, and Facebook is going to be the way that they're going to spend their time and spend their money. So it's a moody business. That's toward the top modes that comes to our mind.
Interesting. Well, the one question that I'm always interested in, because I mean, there's no real answer to it, I guess. I mean, technically speaking, if you wanted to say like market cap wise, you could kind of figure out what the best business to ever exist is. But in your opinion, what do you believe the best business to ever exist?
I want to say tobacco, but that's such a cliche answer. I would honestly say AWS and all of hyperscalers. The reasons are plentyfold, right? We talked about the high switching cost, but there are much more nuances to it that I think general people who are not in the tech sector, it's very hard for them to understand. But if you look at the incentives of the people who actually use the platform, aka software engineers, you will start seeing how this is probably the best business that to have existed, and I think it has a very long runway to go. To give some perspective, we talked about high switching costs, right? Well, there are multiple layers why there is high switching costs.
Mm-hmm.
Previously, so to take several steps back, AWS, when it started 13 years ago or so, it started as we manage these computers, servers for you. You're renting it out, right? When you think about it, on paper, it's a commodity business, right? Like, it's just a computer. Like, computer hardware is at the end of the day commodity business. It was as simple as that. But what they started doing was they started adding value to their customers by creating the most commonly used softwares that software engineers use on the day-to-day basis, right? So EC2 is their hardware renting feature, right? And they started, okay, there are these open source softwares out there, databases out there. Let us manage these open source softwares by installing it on our computers, and we'll manage these databases for you, the customer, so that you don't have to hire a DevOps person, a system admin person full-time to manage these, right? So they basically started becoming the hardware renter to the DevOps of every single business. As one of my friends said the other day, he views AWS as his DevOps. AWS, the whole entity is DevOps, right? So most companies now don't have a dedicated DevOps team. DevOps being, a team that manages the operations of the underlying hardware. They just offloaded that work to AWS, right? So as AWS started building these tools that are generic enough for all their customers to use, customers started getting deeply invested in the ecosystem, right? So I'm talking about not 1, 2, 3. I'm talking about, like, right now, AWS has north of 200 different features as part of the AWS product suite. And each single product solution has about 300 pages worth of documentation. And each single product has thousands of support engineers trying to help their customers figure out the specifications that AWS actually put out, right? This is a huge ecosystem, and the software engineers are deeply embedded and deeply reliant on AWS at this point, whoever is using AWS. And when I say AWS, it's not just AWS. After AWS, Azure came in, GCP came in, and it's the same thing there as well. I'm just saying AWS because it's one of the first companies that started all of it. And so if you think about the software engineers' incentives, why would a software engineer who has spent 3 years, 4 years building enterprise software, learned all these nuances about specifications? Like, as an average senior software engineer would have read about 2,000 pages worth of documentation from AWS. Why would they? What is the incentive they have to go switch to a new job or change their cloud provider to a new cloud provider, right? So they have not just locked in the customers, they've locked in the individual software engineers who work on them. So the incentive is, if I have dedicated 3 years of my life building software with this ecosystem, I am going to continue doing that for a foreseeable future. And the same thing with companies too. A company who has started out as, okay, we are an AWS, we are going to use AWS as the sole cloud vendor, is only going to hire people who are experienced with AWS. They're not going to hire senior, I'm talking at senior engineer levels. They're not going to hire a senior engineer who hasn't had any experience in the cloud provider that they are using, because the answer is they have to spend, the software engineer has to spend at least 6 months to a year's worth of time in trying to understand the parallels in a different cloud provider and building an enterprise grade software. So that cost is actually on the company because they're paying the software engineers, right? And it's lost productivity. No company wants to do that. So it's in everyone's advantage that they stick to an existing cloud provider. And it's not that AWS is or Azure is exploiting this, right? They're actually, there is the scale shared advantage, the economics like Next Leap says. Just AWS works hard, Azure works hard, making sure that they reduce costs as they build out these features on a regular basis. Like if you go look at the costs of individual features, it's not going up, it's actually going down. And customers are actually seeing more benefits for the same amount of money they're spending, right? And it's everyone is reaping the benefits of sticking to the existing players. And at the same time, productivity has increased, right? So you can see how the moat is building around this huge ecosystem. And there are much more to it, right? For instance, the cost of building a hyperscaler, the capex of it would sink nations. It's so expensive and so unprofitable to keep on spending for 10 years and not see profits. And only big companies that just gush cash flows can do it. And that's why Amazon was able to do it. That's why Microsoft is able to do it. And Google still unprofitable, still trying to get there. Same case with Alibaba, same case with Tencent, right? Alibaba just became profitable. Tencent is not. And pretty much the number of players who are going to be in this space is fixed. It's locked in. You're not going to see another player in this ecosystem for another 10 years. Something has to fundamentally change, technologically speaking, for this equation to give out. And that means that no new entrants are going to come in, right? Apple has given up. Facebook has given up. Facebook had all the right tools to build this, but they said, nope, you know what? We are going to focus on our core business. And there aren't going to be new companies who are going to come into the space and be a hyperscaler. It's going to be so hard. So once the competition is, you basically eliminated competition, there are only 5 players here. That means that you can focus on your business, don't have to worry about pricing right, and fear that the new competitors are going to come and undercut you, right? So this is the high barrier, one of the highest barriers to entry, right? It's not easy, and you have so much cost to it, and this high infrastructure cost is actually to their advantage, in my opinion. And there are much more to it. We can talk about the marketplace economics in this business, that not many people understand this. In my opinion, all the hyperscalers enjoy the economics of a marketplace like a Play Store, Google Apps, so the iOS App Store. This is because every single software company, enterprise software company that wants to sell software to other companies, they need to appeal to software engineers to use their software, right? And the way, and since the trend is towards using cloud, they need to be distributed by the cloud provider, the hyperscalers. And this is the AWS marketplace. This is the Azure marketplace, right? So they need to have a relationship with these hyperscalers and allow software engineers to develop solutions using these softwares. Like, for instance, Snowflake, right? They have their software registered as a third-party software in AWS marketplace. And whenever someone uses Snowflake, part of the revenue, just like an app store, goes to AWS, right? And it's not just that, it's also about software engineers' incentives to use the existing products that are provided by AWS. One statistic that people can relate to is there is a reason that Chrome is the most used browser in Android and Safari is the most used browser in iOS. Chrome couldn't come into iOS's ecosystem, and no other player could come into Android ecosystem because distribution matters, native products matters, right? People are not going to download new browsers. They're going to stick with a browser that's good enough. And that's what happens in hyperscalers too. Most software engineers stick to the products that are made by AWS, and most of these products are good enough for most use cases, right? I've asked multiple of my friends who are software engineers and asked them, hey, do you use any software that's like, if you're an AWS, do you use any software that is not provided by AWS? The answer is almost always no, right? A software engineer has a new product that he's developing. He's going to look at what are the tools that are by default provided by AWS, and he's going to use that. He's not going to go look at a third-party vendor when AWS is already providing it. Most people would use Redshift over Snowflake, unless they see a clear advantage that Snowflake provides, right? Most people would use DynamoDB over Cassandra, unless Cassandra provides something that they really want. In most cases, it's not the case. And in most cases, even these features that these third-party providers have are copyable, right? It's at the end of the day software. It's just software constructs, and there are 100,000 engineers in the space right now. 100,000 engineers who work on different systems, adding these features, week over week, releasing these products. So tying all these together, the moat and the economics in the hyperscalers business is so good, and the runway is long. We can talk about the runway specifically, but if you have any questions on this, feel free to ask.
No, let's go into the runway on AWS.
Yeah.
Sure.
Continue.
So I think the world's GDP right now is somewhere about 113 trillion, right? Approximately. It is projected that by 2030, 10 years from now, the GDP would be 180 trillion, right? With 6% CAGR. If you think about it, every single business, irrespective of the industry, right? Restaurants, industrials, infrastructure businesses, utility businesses, all these businesses are increasingly dependent on automation and software, right? And if you look at the amount of expenditure these businesses are making, obviously software companies are going to spend a lot more on IT than non-software companies. But even the most non-software company, let's say a chocolate manufacturer, is spending about 5% of all the expenses on IT infrastructure, right? If you take that as a gross estimation, 5% of the world's GDP is being spent on IT.
For Bluetooth signal.
Right? So 5% of 180 trillion is 9 trillion. And of this 9 trillion, so 9 trillion is spent on IT, but IT is not just the backend infrastructure. You have people involved, software engineers in different companies who need to be paid, right? So on a total basis, if you take any software company, now we are talking about software companies, right? This 9 trillion is software companies, right? You take any software company, 80% of their expenses goes to paying compensation to the software engineers. About 20%, again, approximating, 20% goes to the core infrastructure maintaining the solution, right? So this 20% of 9 trillion would be somewhere around 1.8 trillion. Now we're getting into the territory of TAM. This 1.8 trillion, let's assume that by 2030, 75% of the infrastructure would be maintained by hyperscalers. Right now, it's much lower than 25%, I think. Right now, you can't tell the TAM because most of the industry is managing their own infrastructure, but the trend is going towards hyperscalers. Let's assume by 2030, 75% of the infrastructure will be maintained by hyperscalers, right? So that would be 1.4 trillion. And for the reasons I mentioned above, there will only be 5 players in this industry, right? I would be surprised if there's a 6th player in this sphere. And in the top 5 entities let's assume will take 75% share of the hyperscalers, right? And that's 1 trillion. So for the big 5, the big 5 being AWS, Azure, GCP, Alibaba Cloud, Tencent Cloud, for these 5 biggest players, the TAM is 1 trillion. And if you now from here on, let's just talk about AWS, right? Let's just take the top player. Let's just talk about AWS. Let's say AWS is about 50% market share right now. Let's say AWS in this 2030 end state takes up 30% market share, because obviously the smaller players are going to grow much faster. It's a white space, right? If it takes up 30% market share, we assume 20% free cash flow margin, it would result in $300 billion revenue and $60 billion free cash flows. And if you put a multiple on a multi business like this, AWS alone would have a market cap that's larger than Amazon in 2030. And this is just 10 years worth of runway I'm talking about. Now you have 30% of the world's business's core infrastructure locked in your ecosystem. Let's do a parallel with Oracle. Oracle did that in its day for 20 years. And they've been reaping cash flows for the next 30 years, and companies are still using Oracle. They have no way to get out of it. 50 years after, 30 years after Oracle actually was in prime, people are still using it. Add another 30 years to it. They don't have to grow. They just reap the cash flows, and at that point, they can even pay dividends, buy back shares, right? You don't have to do hardcore, accurate projections to get there. Just simple assumptions will get you the runway that's bigger than most people can contemplate.
We're just going to take a quick minute to talk about Quartr. Quartr is a new way of doing company research. Their first mission is to enable access to conference calls, investor presentations, transcripts, and earnings reports as frictionless as possible, straight to your pocket. Their second mission is to create a completely new way for companies to reach their investors and vice versa, to change the way people look at investor relations. Their initial core product is now available for both iOS and Android, but stay tuned for additional features during the coming year. Quartr is 100% free. They include companies from 15 markets today and plan to add more during the coming year. They prioritize requested companies, which you can easily do in the app. They have a lot more in store for the back half of the year, so make sure to follow them on Twitter. And their Twitter handle is @Quartr_app. And Quartr is spelled Q-U-A-R-T-R. That is Q-U-A-R-T-R. Let's get back to talking with durable investments.
Just unpacking that, there's a lot within cloud computing. I mean, I'm nowhere near at the level that you are at all when it comes to cloud computing, and it comes to even software engineering background or anything like that. So, yeah.
Now, there's one more aspect to all of this, just to round this discussion off. There is this, I think, at least in investor circle, there's this magic number of 1 billion users, right? If you get to 1 billion users, you unlock a lot of things, right? You can sell, like you have established the distribution, and you can sell new products. You can create an ecosystem, right? You become a Google, Facebook, right? That's kind of the magic number. With enterprise, you're not going to get to 1 billion users, but once you get to this some type of percent market share, right? Most companies are using your infrastructure. Until 2030, the name of the game is get to new customers and incrementally produce new softwares to existing customers, right? After 2030, it's basically you've gotten your market share, right? Then just increase productivity for existing customers by providing new solutions to them. So you got the distribution at that rate, right? And after that point, it's basically create new solutions for existing customers. And existing customers is basically 30% of the entire enterprise, right? So they have a really, really long runway, and the distribution power at that point, like ask Microsoft, right? Microsoft is the king of distribution. They have subpar products in every single vertical they are in, but they are the largest market cap company in the world because of their distribution muscle. They can flex this thing. And it's a bet on the management too, right? They have to do the right things. They shouldn't become a day two company like Bezos puts it, right? In case of AWS. So they should keep doing the right things by their customers and keep sharing the benefits of scale. Keep doing it. This thing can go for a while. There is also this concept of, I think in 2020, annual letter basis, as Bezos put it, the customers of AWS are their ambassadors, just like customers of Costco are their ambassadors, right? Like Costco's case, they find a great deal and they show off to their friends. And it's like, hey, did you know I bought this TV for $200, right? Customers are the ambassadors, right? And same thing with software engineers, like the way AWS would grow into white space would be not just top of the funnel marketing, but it's also senior software engineers moving from an existing cloud company, a company that uses cloud, to a different company. And it's like, hey, in my old company, I used AWS and I built this product in 2 months. Let's do this, right? And these people become ambassadors, right? And they obviously want no senior solution architect wants to look like a fool. And they will only suggest products that they are familiar with. That's the incentive there, right? No one wants to, it's like, I've heard a good thing about this new software, but I don't know what I'm talking about, right? They're going to say, I've used this before. This has done the job. Let's go do this. So these customers become the ambassadors for the growth algorithm to kick in, right? And more than to boot, the sales force of these companies are one of the largest in the world. We are talking tens of thousands of salespeople employed in individual companies. Imagine tens of thousands of salespeople trying to sell one of the easiest products to sell, right? And do not underestimate the white glove treatment that these salespeople can provide to the CIOs. I was like, hey, let me give you a 2 years fixed rate deal, and also let's go to this baseball game, right? This and that works, charm. Like that's I don't have to say anything about that. Everyone knows how persuasive these salespeople could be, and they have invested as much on sales and marketing as to engineering. And to boot, I wanted to touch on the recession proofness of this industry, right? Let's take as an example Nordstrom. Okay, one of the bigger companies that are in high-end luxury type products, right? A year like 2008 hits, a year like 2020 hits. The first thing that they would try to cut costs on are ads, marketing, all these peripheral stuffs to be lean. The last thing they would try to cut costs on is to rip their website off. It's almost like utility, but for enterprises, right? It has this interesting dynamic between the customers and hyperscalers. The success of a hyperscaler like AWS solely depends on the success of its customers, right? So AWS tries to provide moratorium type periods if a customer can't pay, because it wants to do everything in its capacity to see the customer succeed. And it also provides this economic, if you look at the economics of it, as a customer, as a company is successful, becomes successful, the more data it acquires. That's the nature of the business. Let's take Nordstrom. Let's say Nordstrom has 1 million customers today. If it grows and it gets 5 million customers, that means they have more data, more on the customers, on the products that they sell, and any distributions, they have more data as they succeed. That means on the core microeconomic level, they're spending more money on AWS. It's almost like AWS, Azure, GCP, all these companies have an equity stake on its customers, if you think about it. Right? It's such a synergistic relationship. And like I said, this also plays into the general productivity increase of the customers tying into the economic benefits of AWS. I used to say, since it's a commodity, like thinking back to commodity business, like it's almost like renting a home, if you think about it, right? Like you're renting a home, your computers, to your customers, to people to live in. That's what AWS is doing at the core of it. But if you look at the business economics of it, you're not charging per month. You're charging for the weight of the house, because you're charging for the data. You're charging on the number of times a renter comes in and out of the house, right? You're basically charging for every single time data goes in, data comes out. right? And you're also charging on top of every single appliance the customer uses inside the house. If you think about it, right? You open the fridge, bam, 0.02 cents. Close the fridge, 0.02 cents, right? So if you think about it, the more the customer activity, the more successful they are, the more successful these hyperscalers are. It's almost a bet on the world GDP, in my opinion, at an accelerated scale.
Interesting. Do you have any opinions on the other 4 businesses within the cloud computing industry?
I think Azure has almost locked its space permanently, along with AWS. You look at the revenues of it, AWS is at about $55 billion. Azure is about $28 billion. GCP is much lower, probably at about, we can't tell because GCP doesn't provide it exclusively. Ballpark about $4 or $5 billion. Alibaba is about $9 billion. Alibaba is actually making more revenues. I think almost equal. Like I said, you can't tell because GCP doesn't provide it. And Tencent is coming up. It's in the 5th place, but Tencent and Alibaba have this white space exploration type of thing going on, and they have the exclusivity over China. And because of that, I think they have a very long runway, and China is very much behind US and other countries in hyperscalers because they saw the growth in these big tech companies in China on their own infrastructure, and somehow they didn't move. I don't know why that happened, but it's starting to move. And so there's a huge white space in China, and I think Alibaba and Tencent are going to do just fine because of the fact that there is no other competition. I think Tencent will make the cut too. And with GCP, most technically focused software engineers, they love being on GCP, in my opinion, anecdotally. GCP has lesser number of products that they provide just because they are newer, but every single product that they provide, they are much more hardcore appealing to the purists. The GCP is probably the hands down best solution for any of the machine learning algorithms out there, just because Google is so good at it in machine learning space, right? So GCP has a lot going for it. It's not profitable yet, but I think it'll make a cut too. I think all these 5 players will make the cut and reach 2030 with cash gushing out. There are other players trying to get in the space, like Oracle. Oracle has OCI. I don't know if Oracle will make it. Its market share wise, it's probably nowhere, but given the distribution muscle, like you can't underestimate the distribution muscle Oracle has over enterprises. Oracle is basically equivalent of Microsoft in a lot of ways. So you can't underestimate Oracle. We'll see how that plays out. But that's basically it. I don't see any other player coming in into the space.
Okay, interesting.
Want me to go?
Yep.
So since you started investing, besides Buffett and Munger, who else has been one of the more influential people?
I would say, the Focus Compounding channel, YouTube channel, and the Twitter, Andrew Kuhn, phenomenal. Any retail investor, I would hands down recommend. If you want to invest in public equities and individual companies, go watch them. This stuff can't be free. It's almost a crime that the stuff they put out is free. So Focus Compounding is a phenomenal channel for anyone to follow. Buffett and Munger, it's basically, there's a Spotify playlist, I think right now, there's a YouTube playlist too, of all the shareholder meetings from 1994 to 2021. That's the podcast that you should be listening to day in, day out, right? If you want to be good at this game. So highly recommend that. Besides from all of this, I think Pat Dorsey's book on moats, How to Build Wealth, the phenomenal starter book for any retail investors, right? And understanding, for any retail investor, understanding how to read financial statements it's number one. That's the first thing that I did. I think I started by reading Accounting Through Lemonade Stand. There's a book called Accounting Through Lemonade Stand. It explains accounting like you are 10-year-old through a lemonade stand, right? How to read a financial statement. I think that is the most hardest part for any retail investor. They understand the business. Most people understand what Facebook is, but the hard part is how to read a financial statement. That's the hardest part, I think, for most people. Understanding how to read a financial statement is probably the number one thing that you should do. Other than that, FinTwit, really smart people are saying, pointing out really, really good businesses out there. It just expands your circle a lot. Like for instance, like I understood what debt means, right? Like before all of this, but like in order to truly understand the power of leverage, like Malone's, I'm talking Malone style leverage, you have to viscerally understand and do some of the case studies as to how people do this thing, right? So having a good, just keeping an eye out on FinTwit, interacting with people who talk about these things. I think it's a great community. I've learned a lot being part of this community. So I would say that's how I started. So that's my answer for that.
And sorry, how long ago did you start?
I've been investing in index funds without understanding what a financial statement is for 4 years, but I started out about a year and a half ago in truly diving deep into companies. About 14 months ago.
Okay. So kind of like the start of COVID. Is that kind of
right before the start of COVID?
Okay.
So kind of timed it pretty well.
Okay. So it must have been that's kind of similar to where me and Jake.
Yeah.
I think we were January 2020 or maybe February 2020 when we started.
That's exactly my time frame.
Yeah.
I'm originally from India. So I went to India for vacation, had some free time, started reading up on the little book from Greenwald, the famous one. Started reading that.
Greenblatt, the little book that still beats the market.
Sorry. Yeah. So started reading that, got hooked, and and then COVID started. I was like, okay, let's get into this. Yeah. It's a lot about timing too. In this business, right? It could be very lucky or very unlucky, even if you're doing the right things. So one of the things that I do prefer, like at this stage, knowing things that I do now, one of the things that I prefer to stick with is managers who do know what they're doing. Kind of takes away a lot of problem from your hand, right? When you have people like Levin at IAC or Malone and Maffei at Liberty, you can just offload the work to them and just wash your hands. I was like, I'm done. Like I don't have to think about that part of money because they'll take care of it, right? The way that I view about investments in general is there are two parts in my view. The first part is where you are investing on the idea of on the hopes that the multiple expands, or you're getting the cash back immediately. Two things, right? In both the cases, you are the operator who has to work towards reinvesting your money, right? So when the multiple expands, you get your cash back, you have to reinvest in another thing, right? So you are doing the work. So you're the operator in this business, right? Second type of investment is where the earnings grow, right? So you're betting on the earnings to grow. In this case, you're offloading the operator's work to the CEO of the company, right? And in that case, you don't have to worry about how the money is being reinvested. They do it for you. A good mix of the both would take you for a very long time, in my opinion. You don't have to stick to one or the other. I think most people try to stick to one or the other. They call themselves, deep value investors or growth investor. I don't think that makes sense. I think you have to look at how your capital is being returned to you and how it's being redeployed, and whoever it's doing it, whether it's you or the operator, they have to do the right job. And if you are confident of that, you're pretty set on investment, right? That's how I view it.
Do you structure your portfolio similarly to any other investors? So like, for example, like if you know Monish Pabrai, do you only pick maybe 7 or 8 stocks that you feel that are, long runways that are compounders for 10, 20, possibly 30 years? Or are you more like, I'll structure half my portfolio for long-term compounding and I'll structure my half for deep value? Or
I think it's a good mix. I don't have rules just because of an individual investor. I think you can skip a lot of these processes and do what you want and be just fine. But I do prefer having a mix of the first bucket and the second bucket. The first bucket being multiple expansion, the second bucket being earnings growth, right? A good mix of that will take you with less agony through cycles, in my opinion. You might have a growth cycle where all the growth stocks are going up because some catalyst, and you will have a value cycle where all the value stocks are going up just because interest rates rose or something, right? And it's kind of painful to go through these cycles, even though as a business owner, you shouldn't be thinking about how where your stock is trading at in the market. You are human at the end of the day, and you get swayed one way or the other based on the market sentiment. So I'm going to take Alibaba, right? Like as a fundamental investor, the thesis would have been, Alibaba has monopoly over retail for the most part, and they have these all synergistic relationship with all their vendors, and if Alibaba goes down, all of China goes down. It's almost a bet on China. You have all these great theses, but you have some market sentiment kicking in, and you might see the multiple compress further, and it is hard to go through it if you are 50% allocated in Alibaba, right? So having a good mix of both the buckets will help you chug along very nicely through cycles, in my opinion. So I would almost say 50-50, like 50% bet on multiple expansions, 50% bet on earnings growth. I don't have it structured that way, but I think that's not a bad idea at all. The concept of diversification is very subjective. In my opinion, if you're doing this full time, you have the capacity to look at individual companies and know when the catalysts are kicking in, when the earnings are growing, when the market sentiments are changing. Stick with, 6 companies, be as conservative as possible. If you are a retail investor who has a side job, you're not going to have the capacity to do that. There's nothing wrong in having more than 20 companies, 30 companies that you do, occasionally follow, occasionally their earnings calls, and just keep tabs on them, right? So I think that's where the diversification comes in. Like most people, like we're basically optimizing for extra returns through concentration versus better sleep at night through diversification, if that makes sense.
That totally makes sense. This is more like a personal question, but how often would you say you spend on investing outside of work per week?
I would say I wouldn't call scrolling through FinTwit as putting time into investing, but I would say anywhere from an hour to a couple of hours a day. Call it 15 hours a week. It depends on what gets you hooked, right? Like for instance, this week I got hooked on the towers companies, right? You go down that rabbit hole and see how moaty that business is. It's almost not work at that point, right? And it's like, oh, cool, right? They have, they can employ leverage to this level and just be fine. That's very interesting. What happened to companies that did do this? What happened to companies that didn't do this? Where are all the returns coming from? Right? The answer, it's basically, unlocking a lot of puzzles and trying to get a bigger picture understanding of an industry at the end of the day. So anywhere from 15 hours to 20 hours, aside from my visits from my day job.
Interesting.
Where do you tend to get your ideas from? Like, do you usually get it from like Twitter, screens, 13Fs?
I used to do a lot of screeners to look at, valuations and multiples. I think that a lot of people go through different trajectory to arrive at where they are right now. My trajectory was value land and then earnings growth land, right? So I started looking at screeners that companies that actually are on sale for lower multiples and slowly graduated to understanding more companies, understanding more industries, and that has, go look at the adjacencies, right? So it's this all of this is adjacency based. What you do understand, what are you trying to go learn and understand, what companies are there. So just explore the adjacencies and explore the graph and trying to find out better businesses, better industries, and then go look at individual companies in there. So it's almost like traversing a graph in computer science terms. So you find which path to take, which path is interesting, you go deep on it, you come back and then go traverse again. That's how I look at it. Better businesses are usually better places to invest money, in my opinion. Better managements are also better places to put your money in. And when two of those coincide, you have something really powerful going on there. And I think that's what happened to all of the FAMG companies, right? You have better businesses combined with better management. You got something truly unstoppable. That's why they have been so successful, in my opinion. Look for look for companies where both coincide, in my opinion.
Interesting. Do you ever look at 13Fs filings?
I have in the past. I have looked at what you have to do the grunt work and understanding individual investor style, in my opinion, to make sense of their 13Fs. Else it wouldn't make sense at all. So, for instance, if you're looking at Tom Russell, you'll have to look at his holdings, look at his speeches to understand how he invests and try to make sense of any investment that he has made. Same with Chuck Ackroyd, right? Like, you wouldn't make sense of what he's doing if you don't understand how he invests, right? You have to know that how he looks for reinvestment and the runway for the reinvestment, right? With Tom Russell, you have to understand that he looks for consumer goods, and he looks for addictive consumer goods with habitual patterns that can redeploy their cash across geographic nations, right? That's how he invests. So you have to understand how these investors are coming, arriving to their investment decisions, and make sense of what they do. But I don't do that much anymore, just because of the fact that there are enough in my radar already. I think once you have this 13F scraping is basically for you to fill your watch list, in my opinion. And once you have your watch list filled up, these certain apps can only serve you some purpose. Beyond that, it's up to you to understand the individual companies and the individual business dynamics and economics behind them.
Interesting. And currently, your portfolio, you said that it wouldn't really make sense for you just to hold 6 holdings or so, that you're a little more diversified. Do you want to talk a little bit about your actual holdings?
Sure. I try to split the individual holdings in baskets just for some clarity around them. The baskets being, each individual basket has a thesis, in my opinion. I don't have the luxury to go dive deep on individual companies and pick the winner. I don't have the time to do that. So I focus on businesses that I think are mispriced for whatever qualities that they have, and kind of make basket thesis bets on them. And in one of those baskets, as we talked about, is the hyperscalers, right? So for 5 company hyperscalers, I'm not going to choose winner among them. There probably is. I'm not going to spend time on that. There, in my opinion, all 5 are going to do just fine. So it's a basket bet on hyperscalers. That's bucket number 1. And bucket number 2 is as I'm starting to understand the importance of the management knowing what they're doing, how management having a hardened playbook for their growth algorithm. The more I'm realizing that I should make the management bets with, as long as they are in a decent enough business, right? So I have a bucket that the thesis is basically I'm betting that the operator is going to reinvest the yield at a high enough rate for a foreseeable time, right? You can think of IACs and charters, and to an extent, you can see and call Facebook that bet, right? And so that's one of the bets. So I'm making these basket theses just so that all I have to care about is, I don't have to care about the quarterly numbers. All I have to care about is the basket thesis broken? That's the only thing that I look at when I'm tracking them. Is like in the management thesis, is the manager doing the right job, is what I'm looking at. If, let's say, Buffett retires, I'll have to reconsider if having money in Liberty ecosystem makes sense, right? So it kind of simplifies the tracking process as a retail investor. One other basket I do have is defense. I am not anywhere close to be an expert in defense. But I do know that defense is one of those industries that has very good capital allocation and a very hard floor on it. So it's one of those, the thesis is basically the US defense is going to do the paternalistic socialism, as Lawrence Aptel in Twitter put it, from one of the books that he read. The US defense is basically going to make sure that contracts are given to the big 5 defense contractors, and they're going to split it to make sure that each one of them survive and their goals are accomplished, right? And they have contracts, like most of these defense contractors have 5 years worth of revenues in their backlog. 5 years. No other company, no other industry can say that. They already have 5 years worth of backlog in their worth of revenues in their backlog, and they just have to execute the capital allocation playbook that they hardened so well. One of the interesting things that I did find was defense budget has only grown 2% per year over the past 50 years, but all their prime contractors have returned more than 13 to 14% IRR. You need prudent allocation that's being taught to the new management over over the course of time to get there. And, there's good oligopoly consolidation happening in the industry. So that's one basket that I do. I like it. The other basket is basically habituals, right? Like basically a bet on humans being addicted to dopamine, right? This could be as simple as Facebook, right? Like whatever you're doing every single day, habitually, and it's a hard thing to get over it. And the last basket is something I call don't overthink it. Whenever me and my family as a whole spend money and we have no other choice to spend money on it, we call it the money pit. I was like, you better buy the stock, else you will beat yourself up, right? Like LVMH is one of those examples. It's a money pit. There's no escaping LVMH. If you are a middle class family in America, you're going to spend your money, hard-earned money on LVMH, and you have no other choice. It would be only prudent to buy those. So these are the 5 baskets that the way that I look at it.
That's interesting that you look at it in 5 different, because the way I look at my portfolio is not really, I mean, to a degree, I wouldn't have 5 baskets, but I have 2 baskets to 3 baskets where it's long-term compounders, where I think that this is a great business. It's something that the likes of Nick Sleep, I guess now Monish Pabrai, like a Josh Tarasoff would be owning. And then I look more into like the 50-cent dollar bills, because I'm still at the heart of it, I still am a little bit of a value guy, and I can't pass up on a good deal if I have some cash lying around. And then I have one business where it's more of a management bet and it's the actual quality of the business, even though that it's called Boston Omaha. I've done a write up on it, and it's a pure jockey play. So it's just the bet on the management instead of the actual quality of the business. I mean, I believe it's hard to predict in 20 years time what the business will be like, but I'm like, okay, well, these managers are able to allocate capital at X rate. I'm going to make a bet on that. But what about you, Jake? Hey Jake, what about you for your portfolio?
I don't look at it in buckets. I just look at it as it's basically the way I look at it is it going to be worth more in the future? And that's the way I look at it. I don't look at it as different segments. I find I don't have enough companies in my portfolio to even really have different categories. But yeah, I just look at it as, will 5-10 years down the road, will this be worth more? And I have a certain hurdle rate. So yeah, that's the way I look at it.
Oh, interesting. Well, Durable, it's been great having you on today on our podcast. I guess our last question is, where can the listeners find more about you, and if they wanted to talk more about AWS with you?
Sure. You can direct message me on Twitter or send a tweet tagging me. My handle is RETAOX, or you can search by my name on Twitter, which is Durable Investments. I'm open to talking anything about all the buckets that I just talked about. So if you have a good idea, if you think that something would be interesting to talk about, feel free to shoot a message.
Awesome. Thank you very much for joining us today. And I'm sure we'll have it back on another time to talk a little more in depth about cloud.
Absolutely.
Awesome.
Thanks for having me, guys.
Thanks
I really appreciate it.
Thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for your entertainment and education purposes only, and we hope that you enjoyed it.